Very good morning, friends. So I hope everybody is doing good. And as usual, I keep telling you that your cumulative revision should be on. So we are now on the last leg of India's 103, that is business combination. And today, our focus point is on two agendas. One is on reverse acquisition and one is on common control transactions. Well, if you remember, we had a total of three agendas of discussion. One was a case of acquisition accounting, wherein we created a 7-step model and we were working in terms of all the 7 steps. Now we've got reverse acquisition as well as the case of common control transaction, which is addressed under Appendix B of the India's 103, and the common control is addressed under Appendix C. Just to remind you, reverse acquisitions can result under two circumstances. Before I come to the accounting treatment, as far as reverse acquisition is concerned, I just need to remind you that there were two circumstances when a reverse acquisition could arise. And we're going to do the questions on both the areas of accounting. So let me just remind you that when you're looking at a reverse acquisition, when you're looking at a reverse acquisition, so there are two areas when a reverse acquisition can take place. Let me just remind you the two situations. So we said in the very first situation, if a new company is not created, and a second situation when a new company is created. And we also saw that consideration has to be in terms of equity share, because the control gets diluted only when the consideration is given in the form of shares. So the first situation is that new company is not created. So the first situation is that the new company is not created, and we can say the purchase consideration is primarily in shares. And the other situation is when a new company is created. When a new company is created, and along with this, the purchase consideration is primarily in shares. The purchase consideration is primarily in shares. If you remember my step number 1 discussion, when we were looking at identifying the accounting acquirer, in that particular case, I'd given you these two situations apart from the consideration being in terms of cash. Now, let me also remind you that when you say a new company is created, I'm looking at the situation number 2. When a new company is created and the consideration is primarily in shares, this is a case where we outrightly said you will definitely see that it would be a case of reverse acquisition. Because one of the existing companies undoubtedly will get a majority shares in the new company. As we saw, two companies, A and B, is created, and A and B are the two existing company, and C is created. So C will give shares to the shareholders of A and B. So one of the two existing companies, A and B, certainly will get a majority shares in the new company, which means that this is undoubtedly going to be a reverse acquisition. Well, I would not say 100%, because it's not very safe to say that. But I would say yes, it is almost like 99% certain that if you see a new company is created and the consideration is primarily in cash, it is like 99% a reverse acquisition. Do we got a question in the study material pertaining to the situation number 2? Yes. And the other one is when a new company is not created and the consideration is in shares. It depends. You cannot say that it would be a reverse acquisition, but the chances are that it could be a reverse acquisition, because all depends upon, I would say, effectively the exchange ratio. Because if the exchange ratio is such that the legal acquirer is giving so many shares to the shareholders of the legal acquiree, there is a possibility that he might lose a control. So this is a case where I would say it may be a reverse acquisition. Everything depends upon I would say everything depends upon the exchange ratio. I'll put it like this, that everything depends upon the exchange ratio. How many shares are you going to issue to the shareholders of the equity, and that would decide the fate. Is there an illustration on the study mat on situation 1 as well? Yes. So we've got 2 questions devoted in the study material on both the situations. I think I'll not tell you at this stage which question is pertaining to which one. But I will definitely show you the question and we will identify which situation is that. So we'll make a walkthrough on the question and we'll see both these questions in terms of reverse acquisition. That was just to quickly remind you that reverse acquisition happens in 2 cases. I think let's now go to a question. We're going to read the question and I will explain the nitty-gritties of acquisition, reverse acquisition accounting through the question. Because the main challenge, or I would say the main, you can say, difference which will arise as compared to acquisition accounting is the calculation of the purchase consideration. And I think we need to do a lot of work in terms of the calculation of the purchase consideration. So I will explain that part when I come to a practical illustration. So there is a question in the test your knowledge at the end of the chapter, at the end. So I'm going to pick up that particular question with you. So that is pertaining to a case of a reverse acquisition. Let me just come to the question out here. Let me just locate that. Here it is, the test your knowledge question number 2. So very carefully, let's read the question and I'm going to do some analysis as we read. I hope the visibility is perfectly okay. Let's now read the question with you. Though in this particular question, we are given the status that it is a reverse acquisition, but I'm still going to identify how do we conclude whether it's a reverse acquisition or not. Okay, I hope the friends, the visibility is pretty good to see. I'll just still further adjust that. I guess good to go, right? Wonderful. So let's read the question to you. It says on December X1, entity A issues 2.5 shares in exchange for each ordinary shares of B. Then he says all of the entity B shareholders exchange the shares in B. So that means it was accepted by all the shareholders of the equity company. Therefore, entity A issues 150 ordinary shares in exchange for all the 60 shares in B. I guess even if you look at the balance sheet below, we can see that there are a total of 60 ordinary shares in the balance sheet of the equity. So when you offer 2.5 shares for every 1 share, that makes it a total of 150. So this 150 is nothing but applying the exchange ratio to 60 shares, and that works out at 150 shares. Then he says the fair value of each ordinary share of entity B is supposed to be 40 and the quoted market price of entity A's ordinary share is 16. So we're given the fair value of the shares as well. And then it says the fair value of the entities A, assets and liabilities are same as their carrying amount, except that the fair value of A's non-current assets is 1500. So all the assets and liabilities have got a carrying amount equal to the fair value, except there is a non-current assets whose fair value is given is 1500. I guess if you look at the balance sheet of the company A, you can see the non-current assets is appearing at a book value of 1300, whereas the fair value is 1500. Now, whether you've noticed or not, I would like you to notice something at this stage. It's something, very a subtle kind of a hint where the examiner is telling you that it is a reverse acquisition. See what is given. It, very clearly says that the fair values of entities A net assets are given. Now, we know that entity A is the acquirer, of course, legal acquirer. and therefore entity B is the legal acquiree. So when you're going to look at the acquisition entry, let's say reverse acquisition is not at the back of my mind. So I would say I need the fair value of the entity B. Are you getting the point? Because if it is a normal acquisition accounting, A is the acquirer and B is the acquiree. So in terms of acquisition accounting, I would need the fair value of the net assets of entity B. And when suddenly he tells you the fair value of the net assets of entity A, which is the legal acquirer, it is, indirectly telling you that this is a reverse acquisition. Reason: if it turns out to be a reverse acquisition, A, the legal acquirer, is going to become the accounting acquiree. And I would need the net assets of the accounting acquiree. I'm going slow, but I'm just giving you very clear-cut idea. Just analyze the information I gave you. So I said, if this is a reverse acquisition, A, who is a legal acquirer, is an accounting acquiree. So when you do the step number 3, A and B, you are going to organize the fair value of the net assets of the accounting acquiree. So by giving you the fair value of A, he is already indirectly told you a hint that this is a reverse acquisition. Though, of course, in the balance sheet also is very clearly saying legal or parent or accounting acquiree, legal subsidiary accounting acquirer. So everywhere, he's very clearly telling you that this is a reverse acquisition, but I will still also tell you how do you identify that it is a reverse acquisition. That was one subtle hint. Next. The balance sheet of A and B immediately before the business combination is given. And then it says in the end, assume that entities B's earning for the annual period is 600 and the consolidated earnings are given. So you're given the entities B earnings and the consolidated earnings for the annual period. Assume that there is no change in the number of ordinary shares issued by B during the year ended March X1 and during the period January till the date of reverse acquisition. So number of shares has not undergone any change as per the instructions in the question. Let's see further. So there is only one more information which is given, that's calculate the fair value of the consideration, measure the goodwill and prepare a consolidated balance sheet. I am yet to give you another inputs as well. As far as the previous question which we did, that was professional and dynamic, and I'm yet to give you insights on the consolidated balance sheet. I do remember that, but I'll give that insight a little later. Let me first concentrate on the reverse acquisition part. Okay, so far so good. I think we've read the question. Now, how would we tackle the question? Well, I would say in terms of reverse acquisition, instead of doing the 7 steps, we're going to do the 6 steps. We're not going to put any journal entry because this journal entry is not to be passed in the books of the legal acquirer. So we need to basically do the accounting from the point of view of the legal acquirer, but considering the accounting from the accounting acquirer. So what did you say? Don't get worried. So let me do one thing. Let me start the journey and let's have a look in terms of how the 6 steps will be applied. The concept remains the same, except there is going to be changes in the purchase consideration, which we will see in deep. So let's begin with, first of all, the step number 1. Now, in terms of step number 1, we need to identify who is the accounting acquirer. Though it is very clearly given that entity B is the accounting acquirer, but I still want to, make it very clear how would you identify that. So let's consider what is the number of shares of A and B. So let's go back to the balance sheet and let's pick up the number of shares in A is 100 and the number of shares in B is 60. So we are given the number of shares in the balance sheet of A is 100 and the number of shares in the balance sheet of B is 60. Now what we are going to do in this particular case, we know the exchange ratio is 2.5:1. So 2.5 shares are being issued for every 1 share. So how many shares are to be given is already stated. It comes to a total of 150 shares. So we can calculate now that what is the percentage post business combination. Because we now need to identify that as far as the shareholders of A are concerned, what is their percentage stake post acquisition. So we can consider they had 100 shares in the company, and now the share capital of this company becomes 250 because 100 plus 150 shares given to the shareholders of B. So let's see what is the percentage stake they get in the company.
Sir,
So
it's
they've got 100
40%.
out of, sorry,
40%, sir.
wonderful indeed. So this is coming to 40% is the stake. Now, there is a little funny question which I want to ask you at this stage, and I think I'm going to get some varied answers. Since it is already stated in the question that it is a reverse acquisition, is there any need of actually doing all these calculations? What is your inputs on that? I know it's a weird question. We just started off the question, and I'm saying since the question is very clearly telling you that this is a reverse acquisition, is there any good need of calculating these percentages? Too early to ask. So let me now make it very clear. Even if the question tells you it's a reverse acquisition, my advice is please calculate this percentage, because I would need this in terms of purchase consideration. This is not really to assess that it is reverse acquisition, but this is also going to be helpful in terms of calculating the purchase consideration. So we need this percentage. So one thing is now very clear based on these calculations that A is lost a control. So in this particular case, we can say that A is supposed to be the legal acquirer. A is supposed to be the legal acquirer, but since he has lost a control, he becomes an accounting acquiree. And similarly, we can also conclude that B is the legal acquiree. He is the legal acquiree, but since he is getting a control, because he is getting a 60% stake, this is the stake of entity A. And if you look at the stake of the shareholders of B, they're getting a 60% stake in their combined entity. So he is supposed to be the accounting acquirer. So this is my step number one, which is not only giving me the computation that yes, it is reverse acquisition, but also is going to help me in my purchase consideration. Okay, then we can go on to the step number two. And step number two is pretty easy. We need the date of acquisition. And as far as the date of acquisition is concerned, it is very clearly stated in the question. It says at the very start on December X1. So my date of acquisition is supposed to be December X1. Okay, so step one and step two is done. Now let's go to the step number three. In terms of step number 3A, we need to see Ind-AS 12, but tax rate is not given. So there is nothing to be seen in terms of step number 3A. Still, we'll just make a mention that when you're looking at the step number 3A, we're looking at the application of Ind-AS 12, and there is no tax rate. Since there is no tax rate, then there is going to be no DTA, or there is going to be no deferred tax liability, which needs to be identified at this stage. Go step by step. Then we go on to the step number 3B, and in terms of step 3B, we need to get the list of net assets. And remember now, very important inputs. When you're organizing the list of the net assets, the focus is the net assets of the accounting acquiree. So get this clear that when you're getting this list of net assets, we need the net assets of accounting acquiree. And in this case, we know the accounting acquiree is supposed to be entity A. So we need the net asset list of the accounting acquiree at this stage. So we're going to look at the balance sheet of A and not the balance sheet of B in order to get this list of net assets. And he's very clearly told us at the very start itself that all the fair value of the assets are equal to the carrying amount except a non-current assets which is appearing at 1500. So let's copy the elements from the balance sheet. NCA is 1500. So we've got a non-current assets 1500. And let's take the other items as well. If you can give me what are the other items in the balance sheet. Look at the balance sheet of A. I guess the current assets is 500, current liabilities 300, and non-current liabilities 400. So we've got current assets, that's 500, and we've got current liabilities and non-current liabilities, and that was to the tune of 300 and 400 respectively. So this is 300 and this is 400. So I think that's it. Let's see what is the net assets of the company A. So this is pretty simple and straight so far. So I think this is coming to 1300, I guess, is the net assets, right? Right. So this is step number 3B as well. I don't think so there is any complications you would have seen arising at this stage. So far, so good. We've just seen the step number 1, getting the accounting acquirer, acquisition date very clearly given. Net assets, only one item is given at fair value. Rest all is the book value. Now comes the interesting part, and that is step number 4. That is calculating the purchase consideration. So now we want to look into the calculation of the consideration transferred or the purchase consideration. Now please hear this very carefully, because what I'm about to do you will easily understand, but I have got 2 agendas to explain out here, and I'm going to create a total of 4 cases out here. So the next 10-15 minutes very crucial. Watch this. Now there is entity A and there is entity B. Now the standard in the appendix B to the standard has given us a very interesting way of calculating the purchase consideration. They say that we know that A gave a consideration to the shareholders of B, but you need to calculate the purchase consideration considering that if, the question is considering if B would have given the consideration to A, what would have been the purchase consideration? So get this straight. Right now what has happened that A is made a payment. A made a payment to the shareholders of B. That's what is given in the question. So in this particular case, this is not the purchase consideration. I don't need to consider what A made a payment to the shareholders of B. I need to consider the purchase consideration if the payment was made by B to the shareholders of A, what would have been the purchase consideration? So get one thing very clear in the mind. Now the standard makes it very clear that in terms of reverse acquisition, PC is not what A gave to the shareholders of B. I need to consider that if B would have given the payment to the shareholders of A, what would have been the PC? But how would I calculate that? And the standard says, in order to calculate this, that if I'm putting the question, if the payment was made by B to the shareholders of A in such a way that he wanted to maintain the same percentage of 60%. Remember, when we did the first step, in this case, we said A gets a 40% stake and B gets a 60% stake. So in this particular case, we want to make the calculations in such a way that B wants to maintain a 60% stake post-business combination. So the objective in this case is if B wants to maintain 60% stake. Now you can see why the calculation of 60% is important. So I think let me put one thing again very clear to you at this stage. When you're calculating the purchase consideration in terms of a reverse acquisition, you don't need to see what the legal acquirer paid, but you need to see what the accounting acquirer would have paid, mind the words carefully. So I don't need to see what A made a payment to B, but I want to see if the accounting acquirer B would have paid a consideration, how much would he would have paid? And for this purpose, you will consider if B wants to maintain a 60% stake, what would have been the situation? Let's do the calculations now. So if you look at the status from the point of view of B, you can see the number of shares in company B is supposed to be 60. Now let's imagine if B would have given the shares to the shareholders of A in such a way that he wants to maintain a 60% stake. Let's consider the number of shares given as X. So let's say the number of shares which he gives to the shareholders of A is X in such a way that he is able to maintain a percentage of 60%. I hope the equation is absolutely clear. So see the calculations carefully. You need to tune yourself on the mind very carefully. We are now looking at things from the point of view of B. So we are saying that if B would have given the shares to the shareholders of A, let's say he would have given X number of shares. The company B has got 60 shares in his own company. And if he would have issued X number of shares in his own company, the total share capital of B would have been 60 plus X. So this X is, we are assuming, this X is what we have assumed what B would have, issued. So what B would have issued to the shareholders of A. So we are calculating that what would have been given to the shareholders of company A if he wants to maintain the same percentage. Solve the equation, you get the value of X. So if I solve this equation, I think X to my mind is coming to 40. I hope,
Yes,
friends,
sir.
I'm clear with this percentage. Great. Am I clear with the calculation of this value of X in the sense the concept, not the figure? That you're trying to visualize that if B would have given the shares to the shareholders of A in such a way that he maintains the percentage of 60%. So you're going to make these calculations to identify what the number of shares B would have given to the shareholders of X. Right, friends? I hope I am clear with the picture, correct?
Yes, sir.
Wonderful indeed. Okay, now once you've identified this, I have reached my calculation of the purchase consideration. So when you're going to calculate the purchase consideration, we are saying number of shares which would have been issued. Number of shares which would have been issued. So number of shares which would have been issued by B to maintain 60% stake. That is post business combination. So the focus is to get what is the number of shares which would have been issued. I'm using the word which would have been issued by B, so that he wants to maintain a 60% stake. So B would have issued a total of 40 shares. And what is the fair value per share of B? So what is the fair value per share of company B? And we're also given in the question, what is the fair value of company B as well? So in the second para, it says the fair value of the shares of B is to the extent of 40. So we know the share value is 40. So if you multiply 40 into 40, that works out at 1600. That is the purchase consideration. I want to do some more analysis, friends. At this stage, my computations is done, but I am not done because I want to do some more calculations at this stage. Now watch this. I am just thinking that if I were to calculate a purchase consideration in a normal manner, had this not been a reverse acquisition, I want to calculate the purchase consideration in a normal manner. Then how would I calculate the purchase consideration? Can I say I would have considered what is the shares A issued to the shareholders of B? That's 150. I'm just trying to calculate that what would have been the purchase consideration if it was not a reverse acquisition. So this is a PC if it was not a case of reverse acquisition. We're just doing that for simplicity. So A gave to the shareholders of B a total of 150 shares. And what is the fair value of company's A share? So we're given the market price of A share is to the extent of 16. So if you multiply this with the fair value per share of company A, that is 16. Let's see what is the purchase consideration. So that's 150 into 16. I guess it works out at 2400.
2400.
Great, wonderful indeed. So you can see, now you must be thinking, why am I calculating the purchase consideration ordinary way? I don't need that. I've just computed it just for the sake of understanding some more concepts. So this is the purchase consideration, which is generally calculated. The number of shares issued into the fair value per share, and you get the PC. But in reverse acquisition, this is not the PC. In a reverse acquisition, the PC is you need to visualize and calculate if B, the accounting acquirer, would have issued shares to the shareholders of the accounting acquiree to maintain the percentage of 60, how many shares he would have given into the fair value of B, and you get the purchase consideration. I guess, friends, if I am absolutely clear, I want to do some more analysis with you on this PC. Ready?
Yes, sir.
Wonderful indeed. So I am now going to do some analysis. I am going to create now 4 cases with you. I'm going to create a total of 4 cases with you. You must be wondering, what is this 4 case? My concept of purchase consideration is not yet over. There is something more which is given in the standard, which I need to illustrate and elaborate to you. So watch this. I am looking at case 1. I am looking at case 2. I'm looking at case number 1, and I'm looking at the case number 2. And within this, I'm looking at 2 situations. And within this, I'm looking at 2 situations. I'm looking at situation number 1. I'm looking at situation number 2. Here also, I'm looking at situation 1, and I'm looking at situation number 2. Now, in this particular case, as I see, I'm looking at the case number 1 if it is not a reverse acquisition. I'm looking at the case if it is a reverse acquisition. So 2 broad cases. I've already looked at 2 situations in each of the cases. I'm looking at it is not a reverse acquisition, and I'm looking at it is a reverse acquisition. Now watch this. If it is not a reverse acquisition, I would consider the shares which A issued to B. Can you tell me what is the number of shares A issued to B? What is the number of shares which A issued to B? Can I say 150? And what is the fair value of the share of company A? I guess the fair value of the company A was
16
16.
rupees.
Yes, right. And this is the purchase consideration, which I've just done in the previous slide. Now, friends, hear me carefully. The standard has made a statement. I'm not talking of reverse acquisition. I'm talking of what the standard says in the main part. It says if the purchase consideration is only in equity shares. I did not say mainly. I did not say primarily. The standard says that if your purchase consideration is only in equity shares, the purchase consideration is more reliable if you calculate the fair value of what you acquired instead of considering the fair value of what you issued. Please analyze this carefully now. The standard says that as a company A, if you are going to give a consideration only in equity shares, purchase consideration is more reliable instead of considering the fair value of what you gave. You should rather consider the fair value of what you acquired. Did you get my point? Did you get my point out here? No, sir. I will explain that with a practical figures now. So in situation number one, what you've done, you've taken the fair value of the shares issued. You've taken the fair value of the shares issued. But I said, if the consideration is only in equity shares, if your purchase consideration is only in equity share, so the situation number two applies when the purchase consideration is only in equity shares. So the standard says in this case that your purchase consideration should be not equal to the fair value of the shares issued, but you should take the fair value of the shares acquired. Now let me say something. Company A, by issuing 150 shares, got the control over 60 shares of B. Please mind the words carefully. Company A, by issuing 150 shares to the shareholders of B, got a control over the company A. So what he acquired is a control over 60 shares. So I am looking at, in this particular case, what is the fair value of the shares acquired. I want to get the fair value of the shares acquired. So A, by issuing 150 shares, gets a control over the 60 shares of B. And the 60 shares of B is got a fair value, which is 40, and the purchase consideration comes to 2,400. Did you get the analysis? Did you get the analysis? Be very candid, yes or no? I'll explain otherwise. This is fair value of what is issued, and this is fair value of what is acquired. Did you get my analysis? I think I got a yes. So I believe that is a representative sample. So let me put it like this again. If you remember the provisions of Ind AS 16, when you are looking at a exchange of assets, you always try to identify that what is a more reliable basis. That when you acquire an asset, what is more reliable in nature? Is it the fair value of what I gave, or is it the fair value of what I acquired? So I need to consider that should I take the fair value of what is paid by me, or should I take the fair value of what is acquired by me? So the standard in Ind AS 103 makes it very clear. It says that you need to be careful. You know, the general technique which you have learned in the calculation of the purchase consideration in all the questions so far is that you consider fair value of what is issued. So generally, when you calculate a purchase consideration, you say 150 shares actually issued by the acquirer into the fair value per share. So we always consider the fair value of what is given. The PC is the fair value of the shares issued. But the standard says that if the purchase consideration is only in equity share. So, but you never did this in earlier questions. If you recall, in the earlier questions, the purchase consideration was not only in equity shares. Do you remember the questions I've done with you? Did you see in those questions that the consideration was only in equity shares? In none of the questions, the consideration was only in equity share. If you remember the question number one, the TYU1, which we did in the previous class, in that particular case also, the consideration was paid in cash and in terms of shares. Even if you look at the question of professional and dynamic, the purchase consideration was including some deferred considerations and other components as well. This is the first question you're looking at today, that where the purchase consideration is only and only in equity share. So this particular concept is going to be applicable only and only if the purchase consideration is in equity share. So the standard says the more reliable measurement when the consideration is given in shares. Don't see what you are giving. See what are you acquiring. So watch the movements clear. A Limited is telling the shareholders of B that I'll give you 150 shares in my company. This is what you gave. But in return of giving this 150 shares, what do I get? I get the control over the 60 shares of B. So one way of looking at is that what I gave is 150. You take the fair value of that. and what I get in return is the control over 60 shares, you take the fair value of that. Am I absolutely clear? Am I absolutely clear on the agenda, right? Yes, Beta Pooja,
Sir,
I think you've got a question. Yes,
sir, you said if the purchase consideration is paid in only equity shares,
correct.
means even if some payment for fractional amount is paid in cash, even that case will not cover here.
There is no interpretation given on that particular para number, whether only in shares would mean a fraction or not, because I've not even seen a single question on India's 103 where there is a fraction. So difficult to make any commentary on that part, but the wording is only. So to my mind, if there is a cash because of fraction, I think the concept should still apply. But the main parameter is that there should be no conscious consideration in any form other than equity share. That's what my interpretation is.
Okay, sir, clear.
Wonderful. So though this is not the case. It is a case of reverse acquisition, but I'm just trying to give you a clarity. By the way, there is another question which is coming to the mind as well, and that is, if you notice in these two cases, the purchase consideration is same. Is it by chance or is it got to be? Because the fair value of what is given and the fair value what is acquired is same. By chance or got to be? GDB, what do you say? Difficult to comment. I think I'll do the analysis as well. I know that today, early in the morning, my analysis is going to take place. Now, let's see you something very interesting back in the question so we can visualize something very interesting at this stage. Now, if you go back and look at the question, the fair value of company B is 40 and the fair value of A is 16. The share price of B is 40 and the share price of A is 16. So B has got a share price 2.5 times. The exchange ratio is also 2.5 times. Can I say naturally, B will say, boss, I'm more powerful than you. He will tell A that your share is 16, my share is 40. So my share is 2.5 times your share. And that is the reason that when you get the exchange ratio as well, they decided to issue 2.5 shares for every one share. Now you would start thinking more. So what if the exchange ratio doesn't turn out to be 2.5? Well, of course, the answer 2400 will not match. But then I think in a very idealistic situation, the exchange ratio has to be based on, you can say undoubtedly, on the fact that if the share price of company A is 40, B is 40, naturally B is going to demand more shares for every one share. Because B will say that I am more powerful as compared to you. Your share is only 16, my share is 2.5 times. So you need to pay me enough consideration so that I stand at same levels. And therefore, we can undoubtedly go back and say that in this particular case, this 2400 and this 2400 is got to be. And the reason that it is got to be is because your exchange ratio is supposed to be 2.5:1, which is based on the market price, and therefore it is the same. Super. Now, friends, we are back on the question. We are actually on a reverse acquisition. So I'm more concerned with the case number 2. I'm more concerned with case 2 because it is a reverse acquisition. I know there are more questions coming to your mind, which I will answer very shortly. Now, as we said in situation number 1, if it is a reverse acquisition, I need to see how many shares would have been issued if B would have given the shares to the shareholders of A. So I want to understand what is the shares which B would have given to A. And I think we calculated that was 40 shares. Because when you're calculating the purchase consideration for a reverse acquisition, you need to consider not what is given, but what would have been given. If B would have maintained a 60% stake, he would have given 40 shares, and the fair value of the shares of B is 40. So the purchase consideration in this case is 1600. Now comes the $1,000,000 question. Where we are trying to look at the second situation. Now, let me ask you a question. If you can answer this, then your fundas are going super duper. I now need to consider that if B gave if B would have given the shares to A, please visualize carefully. If B would have given the shares to A, he would have got a control over how many shares? Because I need to see what is acquired, not what is issued. So this is what would have been issued. This is what would have been issued. So if B would have given the shares, this is what would have been issued to the shareholders of A. I now need to understand what would have been acquired. What would have been acquired? So can you tell me what would have been acquired in terms of B? If B would have issued a total of 40 shares to A, how many shares would he get a control on? 100. That is the number of shares. So we would have said he would have got a control over 100 shares of A. And the fair value shares of A is at the rate of 16. And this also works out at 1600. And of course, we've already seen that this is again not by chance, but this is again got to be for the reason the exchange ratio is 2.5:1. I guess there would be a little confusion. Say yes or no. I can clarify the confusion very easily. Say yes or no. You want me to consolidate this once more, tell you the 4 cases, how you would visualize if the consideration is primarily in cash? Yes or no? I
Got it, sir.
presume. Clear? Wonderful. So I'll still, put the diagrammatic view to you to get this clear. So what I'm looking at, just to get it very, very clear so that there is no confusion in life. Let's, I think, visualize one thing very clear. I'm just going to put 4 questions to you. Ask the 4 questions to yourself and you'll be very clear. Now, I am looking at if it is not a reverse acquisition. I am looking at if it is a reverse acquisition. So I'm looking at the cases if it is not a reverse acquisition. So if it is not a reverse acquisition, then we are saying that he is the accounting acquirer. He is the accounting acquirer and he is the accounting acquiree. He is the accounting acquiree. So there are 2 cases what we're looking at. Let's put the number of shares as well. The number of shares of this company is 100 and this is 60. So let's make this quick inputs out here. So I am now looking at the fact that the purchase consideration is not only in equity shares. It is not only in equity shares. Or we are looking at the fact that it is only in equity shares. Or we are looking at the fact that it's only in equity shares. So get the points very straight. Now let's put the questions to you. If this is not a reverse acquisition and the consideration is not only in equity shares, what do I consider? The shares issued or the shares acquired? Tell me.
Issued.
Wonderful indeed. I will consider the shares issued. So can I say he issued 150 shares in his own company at the rate of 16? That works out at 2400. Super. Let's put the second question now, friends, to you. If this is not a reverse acquisition and the consideration is only in equity shares, by issuing 150 shares, how many shares did he get a control? So what did he acquire? Give me the number. By issuing 150 shares, what did he acquire?
Control over the company B, that is 60 shares.
Wonderful indeed. That's right. So he gets a control over 60 shares of B, which has got a price of 40 that works out at 2400. So now you can see the position very clear. That when the consideration is not in shares, see what is given. And if it is only in equity shares, see what you get. So by issuing, you can say 150 shares, you get the control over the 60 shares of B. So you get a control over 60 shares by issuing 150 shares. Now let's change the focus. Now I'm looking at it is a reverse acquisition. Let's organize the data again. So this is now the accounting acquiree. Since it is reverse acquisition, it is accounting acquiree, and he is the accounting acquirer. He is supposed to be the accounting acquirer. So let's take the same number. This is 100 and this is 60. So we are again looking at the two combinations. When you say the purchase consideration is not only in equity shares, the purchase consideration is not only in equity shares, or it is only in equity shares. So let's again focus in terms of these calculations again. Now let's give you the focus points once again. It is a reverse acquisition, but the consideration is not only in equity shares. What should I consider? How many shares issued or how many shares which would have been issued? What do we consider? Which would have been issued, right?
Yes, sir.
Correct. Which would have been issued. Can you tell me how many shares would have been issued?
40.
That's right. We made the calculations assuming that X, that 40 shares is what B would have given to the shareholders, and each share is worth 40. That makes it 1600. And now coming to the last case, if the consideration was only in equity shares and it is a reverse acquisition, by giving these 40 shares, what would B get? I think I'm already answering. Basanti, tumhara naam kya hai?
Yes.
That's right. It is 100 shares. So we can say what would have been acquired. What would have been acquired. So I'm putting it clear what would have been acquired in this case. He would have got a control over 100 shares of A at the rate of 16. That makes it 1600. I hope, friends, I am 100% clear on all the four permutation combinations. If you look at the study material answer to the TYU2, the calculations of both these considerations is given in the question. In the solution, they've given both of them. There is a clear-cut insights which is given about the para which I mentioned, that if your consideration is only in terms of equity share. Now, the million-dollar question which would be coming to your mind is, sir, am I supposed to show both the purchase consideration to the examiner? I would say yes. So, but is the answer going to come the same? I hopefully assume that the exchange ratios is based on the market price. And if it is based on a market price, that is 40 and 16, 2.5. I have fairly assumed that you will definitely get the same consideration as well. So that leads me to a conclusion that can I just do one? I would say no. If your consideration is only in equity shares, you need to tell the examiner that you are very conceptually clear on the agenda, that if the consideration is only in equity shares, we need to show the calculations based on not what would have been issued, but what would have been acquired by issuing those shares. So far, so good. Clear. Wonderful indeed. I am now back on the solution. This was doing a little more PhD on the calculation of the purchase consideration. So this was my step number 4. My calculation of step number 4, that is the purchase consideration is done. Now let's go to the step number 5, and the step number 5 is getting the NCI. In this case, there is no NCI because all the shares have been acquired. So let's put the step number 5. So I'm just putting the step 5, though it's not applicable. So step number 5 is on the calculations of the NCI. And in this case, there is no NCI because all the shares of B acquired by A. Now let's go to the step number 6, which is the calculation of the goodwill, which is the calculation of the goodwill or the bargain purchase gain. That's the capital reserve. Similar calculations will be done in this case. You take the purchase consideration and to this purchase consideration add the NCI, if any, and compare this with the net assets on the acquisition date, which is in step 3B. So purchase consideration is 1600. There is no NCI. And what was my net assets in step 3B? 1300, I guess.
Yes, sir, 1300.
Great. So we get a goodwill to the extent of 300. So that gives me the step number 6 as well. Now we are in a comfortable position to make the consolidated balance sheet. We're not going to put any journal entries in reverse acquisition. Now we need to make a consolidated balance sheet. Now there are a few inputs which you need to be clear when you are going to make the consolidated balance sheet. There are a few inputs which we need to be very clear as we make the consolidated balance sheet. So let me give you those 2-3 inputs at this stage. Number one, the consolidated balance sheet needs to be prepared by the legal acquirer. That is A. Because at the end of the day, the requirement under the Companies Act is that the consolidated balance sheet is going to be prepared by the legal acquirer. So what we need to do when you're making the consolidated balance sheet, you need to make it from the legal acquirer's point of view. You're going to make it from the legal acquirer's point of view. So this consolidated balance sheet is going to be prepared by E. Since it is going to be prepared by A, there is one important caution to be kept. The number of shares appearing in the balance sheet has to be from the point of view of the legal acquirer. So when you are going to show the number of shares in the balance sheet of the consolidated balance sheet, we will take the number of shares from A's point of view. A has got 100 shares in the company. He issued 150 shares. So he is going to show a total of 250 shares in the balance sheet. So one important implication is that since the legal requirement to make the consolidated balance sheet falls upon the legal acquirer, the number of shares which you are going to show in the balance sheet of the company is from the point of view of A. So he's got 100 shares and he's issued actually 150 shares to the shareholders of B. So we're going to represent 250 shares. That's number 2. Second, rather I would say point number 3. When you make the consolidated balance sheet, the accounting is going to be done from Ind AS 103 perspective. So when you're going to make a balance sheet, the accounting is being done from the point of view of Ind AS 103. And from the point of view of Ind AS 103, when you take the values in the balance sheet, when you take the balance sheet values, you will take the fair values of A and you will take the book values of B. Because A is the accounting acquirer. So when you're going to make the balance sheet from the amount column perspective, this was from the number perspective. So this is from the point of view of the number perspective. But when you're going to take the values in the balance sheet, from the values perspective, you will take the fair value of the accounting acquirer A, and you will take the book value of the accounting acquirer. Because when you make a balance sheet, you need to consider the fair value of the acquiree. So in this case, the values are picked up because A is the acquiree. The number is picked up because A is the legal acquirer. So confusion? It's very simple. Consider the inner side of the balance sheet and consider the outer side of the balance sheet. Inner side means I'm looking at the number. Outer side means I'm looking at the values or the amounts in the outer column. So when you're looking at the number, you need to see the number from the legal acquirer point of view. When you're going to look at the values, you're going to look at from the accounting acquirer point of view. So number from the legal acquirer. So let's put it down. I think let's put it down also very clear that when you're going to look at the number is being seen, as I've already said, from the legal acquirer perspective. From the legal acquirer perspective, the values will be seen from the accounting acquirer perspective. And therefore, the fair values will be taken for the acquiree. Right, friends? I hope I'm clear with the picture. So now with this, let's make the consolidated balance sheet of A, who is the legal acquirer. So let's apply these principles and let's see the consolidated balance sheet as well. So this is the consolidated balance sheet of the legal acquirer, that is company A. So we'll go back to the balance sheet and we are now going to pick up the inputs. So what we're going to do, I will take the fair values of A and add the book values B. So I think I've kept the balance sheet in front of me. So we can just, I think, organize the data. So let's go back on the consolidated balance sheet. So I'm starting with, first of all, the non-current assets. So on the non-current assets, you take the fair value of A. I guess what was the fair value of A? The fair value of A was, I think, 1500. And you take the book value of B. The book value of B, I guess, is 3000. So this works out at 4500 is the non-current assets. Then the only item on the current assets, here again we need the fair value of A, though the book values of A and fair values for all of the assets are same. So that is 500 and 700. That works out at 1200. And I guess that's it. Nothing else is there on the asset side except that there is a goodwill. How much was the goodwill? I guess 300, if I rightly
300.
remember.
Yes,
Yes.
sir.
So let's see what is the total of the asset side, 6000. Then we can also see the liability side of the balance sheet as well. So let's see what is the status on the equity and on the liability side. So as far as the equity is concerned, we're going to consider the equity share capital. So when you're going to show the number, we've already said we will show the number from the legal acquirer perspective. There is 250. Amounts are to be taken from the accounting acquirer. So we will consider the amounts based on the share capital of B, accounting acquirer, plus the PC. So in this particular case, if I consider what was the amount of share capital of this company, I guess the share capital of company B is appearing in the balance sheet to the extent of 600 shares and add the purchase consideration. This is the share capital of B and this is the purchase consideration which would have been issued. So that works out at 2200. The figures in the outer column is from the accounting acquirer perspective. Next on the balance sheet is given the retained earnings that would also be for the accounting acquirer, and that's appearing to the extent of 1400. Had there been an NCI, we would have taken that NCI in the equity as a last item, but we're not given any equity. And then we are given the non-current liabilities and the current liabilities as well. So as far as the non-current liabilities are concerned, it is A plus B, 400 plus 1100, that makes it 1500. And as far as the current liabilities are concerned, it is 300 plus 600, and that makes it a total of 900. So let's see, is the balance sheet agreed at 6,000 or not?
Yes, sir.
Wonderful indeed. So this is the total of the balance sheet. The assets and liabilities are matched. Super. I know this is a little complicated affair, but I think it's a very, very interesting input as well. Once you practice this, you're going to get a good hang in terms of reverse acquisition. By the way, which case was this? We started a journey on 2 cases on reverse acquisition. Which case was this? 1 or 2? A and B were existing company, no new company was created. Can I say this was case 1?
Yes,
If you
sir.
remember, correct.
Sir.
So now we need to go to the next case where there is a new company which is created, and I said that would undoubtedly, in all probability, always be a case of reverse acquisition. Let's do that question now. So there is another question, illustration in this study material, and that is dealing with the agenda of reverse acquisition, though it also contains a common control part as well. But we want to basically first have a look at that. It's by the name of AX. PX, a similar kind of question has come in the exams as well. Yes, here it is. This is again a beautiful question indeed. Illustration number 38. This is illustration number 38 in the study material. So I guess let's have a look at the illustration number 38. Wow, wonderful indeed. Now you need to suddenly get a little changeover in mind. So we are still on reverse acquisition, but we are in a case where a new company is created and undoubtedly it becomes a reverse acquisition. Let's, I think, read the inputs. At the very first start, it says AX and BX are amalgamated on January X2 acquisition date. A new company ABX with the shares of 10 each is formed to take over the business of existing company. Aha. Since a new company is created and if the consideration happens in shares, it's going to be undoubtedly a reverse acquisition. Let's have a look. So we're given more inputs in the additional information. So I am given ABX will issue a requisite number of shares to discharge the claims of equity shareholders about the company. Also, new debentures were issued in exchange of the old series by both the company. You need to prepare a note showing the purchase consideration and a discharge, and also draft the balance sheet of ABX. We're not doing the A part right now because we're yet to study the concept of common control. So we'll come back to this question when we come to the common control after this. Assuming BX is a larger entity and the management will take a control of the entity ABX, he's already very clearly said that BX is the larger entity which gets a control over the new company, which means BX is supposed to be the accounting acquirer, though he is supposed to be a legal acquirer. The fair value of the net assets of AX and BX is also given. Great. Here again, I am very clearly given that BX is supposed to be the accounting acquirer, which of course means that it is a reverse acquisition. But if you remember, when I said you are going to do the step number one is not only crucial to identify the legal accounting acquirer, but I need that percentage as well, which I need for the calculation of my purchase consideration. So whatever calculations we're going to do in step number one is from the point of view of calculating a purchase consideration. Don't be, get happy with the fact, oh, the examiner is telling me that this is a reverse acquisition. Step number one, no calculations required. You need the percentage for the purpose of calculating the PC. Step one is undoubtedly required. So let's do one thing. Let's begin the journey and we are going to go step by step. So let's go to the step number one, where we are going to first of all identify the accounting acquirer. So we're going to first of all identify the accounting acquirer in this particular case. Now, when you look at the accounting acquirer, I do the same calculations. In this case, by the way, is the consideration primarily, or I would say, is it only paid in shares? Yes or no?
Yes, sir.
Yes, so which means I need to do my calculations based on both the facts, what would have been issued and what would have been acquired in lieu of what would have been issued. Ah, super. So we've got two companies, AX, and we've got the company BX. Let's first of all organize the number of shares in the balance sheet of the company. So let's go back and see what is the number of shares in the balance sheet of the company. So we are given a total of 600 shares, 10 each, 700 shares, 10 each. So we've got 600 and 700 shares. So there are a total of 600 shares and there are a total of 700 shares. Now, what we need to do, first of all, C, the number of shares which is being issued to these companies. Now, if I come back on the additional information, it very clearly says ABX issued a requisite number of shares. How many shares is not given? Requisite number of shares to discharge the claims of the equity shareholders of the transferor company. Now, if you notice in the last block, you are given the fair value of the businesses, that is 11,000 and 14,000. So naturally, when the company ABX will issue requisite shares to both the companies, he will issue shares on the basis of fair value of the businesses. And since the new company ABX is a new company, I assume the shares will be issued at the rate of 10, which is the face value of the shares. So in this particular case, let's note down 11 and 14. So we are given the fair value is 11,000 and the fair value is 14,000. This is the fair value of the business already given in the question. So considering that the shares will be issued at a face value itself, which is 10 rupee. Because I am given that the company ABX is a new company. So since it's a new company, there cannot be any fair value. He would issue the shares at a face value. So what is the number of shares issued? So what is the number of shares which is issued? He will be given 1100 shares.
And
That's
1400.
right. And he will be given 1400 shares. So the total capital of the company ABX is going to be 2500. Now we can see that company ABX will issue 2500 shares, out of which 1100 shares goes to AX, 1400 shares goes to BX. So let's see what is the percentage stake. Let's see the number of shares which AX and BX gets in ABX. He is getting 1100 shares out of 2500. And the shareholders of BX are getting 1400 shares out of 2500. So let's see what is the percentage. Anji beta.
44% and 56.
44% and 56%. And I think this 56% itself is indicating that he is getting a control over ABX. Because out of the total shares, he gets a 56% stake in the company. So this indicates that he is the accounting acquirer. And this itself is indicating that this is definitely a case of a reverse acquisition. And just to remind you once again, though this fact that it is a reverse acquisition is already given in the question, I am still doing the step number 1 because I'm concerned with that 56% figure. Because without that 56% figure, I cannot derive my purchase consideration. So this calculation is important, even if I am clearly stated in the question that who is the accounting acquirer. Okay, so this is step 1. Let's go to step number 2. So now we go on to the step number 2, which is the date of acquisition. And I think that is very clearly stated in the question. So that was very clearly given in the question. The date of acquisition was January X2. So the date of acquisition is very clearly given, January X2. That's not a big deal. Then again, we come to the step number 3A as well as step number 3B. Step number 3A, we need a deferred tax. There is no tax rate given in the question and therefore no deferred tax implications. So the application of Ind AS 12, and in this particular case, there is no tax rate given. Since there is no tax rate given, the calculations of a DDL and a DTA is not required to be done. Now let me ask you another obvious question. In terms of the step 3B, we need to get the net assets at a fair value. Which company? Net assets. Which company are you going to pick up the net assets at a fair value?
Accounting acquiree.
And which company is the accounting acquiree? Can I say AX?
AX.
Yeah.
Yes. So we need the net assets of the company AX, who is supposed to be the accounting acquiree. Because when you're considering the status of the list of net assets, we need to get the net assets of the accounting acquiree, which is AX, because BX, who is also the accounting acquiree, legal acquiree, is basically accounting acquirer. So let's go back to the status of the fair values of AX. I guess we are given the fair value of PPE and inventory. Rest nothing is given. So we can just have a look at the items in the balance sheet. Let me just open up the figures in front of me as well, so that we can just incorporate them. So let's begin with the fair values of PPE. That's to the extent of 9,500. Inventory is 1,300. So we've got a property, plant, equipment is 9,500. Inventory was how much? Fair value 1,300, right?
Yes, sir.
Okay. Then rest we can take all things at a book value itself. So I guess we are given investments, that is 1050. Except for inventory and PPE, everything else is at a book value. And the next item, trade receivables, is 1,800. And then there is a cash and a cash equivalence. That's to the extent of 450. That's on the asset side. And if you look at the liabilities, we are given the borrowings, that is 3,000, non-current liabilities. The borrowings are 3,000. And there is another current liability as well, a trades payable, which is 1,000. So this will give me the status of the net assets at a fair value on acquisition date. So 95, 1,300, 1050, 1,800.
So it is 10,100.
Yes, that's right, 10,100. That is the fair value of the accounting acquiree. Great. Now comes the most interesting and the crucial step indeed. Step 4, that is the purchase consideration. So let's see the step number 4. So in terms of step 4, I'm going to do 2 calculations as we did in the previous question as well. Because one, I want to do the calculations based on what shares would have been issued. Am I supposed to calculate the shares which company BX would have issued to AX to maintain a 56% stake? What do you say? If I want to calculate the status of the PC, can I say we need to consider that this company BX, which is accounting acquirer, what would he have issued to the shareholders of BX, correct? So we want to calculate BX would have issued. BX would have issued to shareholders of AX. What is the number of shares BX would have issued to shareholders of AX to maintain 56% stake in the company? Because he's got a 56% stake in the company. So I want to calculate in this case, if he wants to maintain a 56% stake in the company, how many shares would he have issued? Now, for this purpose, I think I need to organize a little more inputs as well. So let me do one thing. Let me also organize a bit more data. If you remember the question which we did last one, that was A and B, the fair values of the shares was very clearly given. But in this case, the fair value of the shares is not given, but you're of course given the fair value of the businesses. Since you're given the fair value of the businesses, we can easily organize the fair value of the shares as well. So as a small working note, we can just organize the fair value per share. So let's see what was the fair value of the business, which we had seen earlier as well. What was the fair value of AX and BX, I guess?
11,000 and 14,000.
Great. 11,000 and 14,000. And let's see the number of shares in the balance sheet of these company.
600 and 700, sir.
Wonderful indeed. So we will be able to get the fair value per share. This is what we need for the calculation of the purchase consideration. So 11,000 by 600 comes to 18.33,
18.33.
and that's 20, I guess. Right, so this is just a working note which we've organized, because unlike the previous question where the fair value was clearly given 40 and 16, in this case it is indirectly given, so we just organize the data. Okay, so now coming back to the issue, what would have been the shares which AX would have given to BX to maintain a 56% stake? So let's do the calculation. Can I say the number of shares the company BX has got in his own company is 700 shares. Let's assume that he would have issued X number of shares to BX to AX shareholders in such a way that he wanted to maintain a 56% stake. So this X is a presumption regarding how many shares the company BX would have given to AX. I'll just make a mention that X is supposed to be assumed. This is what we have assumed as number of shares which would have been given, the number of shares which would have been given to shareholders of AX. So we are assuming the number of shares which would have been given to the shareholders of AX. So let's say he would have given X number of
It's
shares.
550 shares.
That comes to about 550.
550 shares.
Okay, great. So we get 550 shares is the number of shares which would have been issued. Now we're going to calculate the consideration twice. One is based on what would have been given, and one based on after giving that, what would he had acquired. So now let's get the status from your side very clear. Let's get this from your side. I'll
Sir?
put two questions. Anji beta.
Can we make calculations such as a value of the A's business was 11,000 and B was supposed to give him shares at 20, then it will also come to 550?
Yes. By default, you'll always get the same answer because exchange ratio is based on fair valuations only.
Yes, sir. Means,
Correct.
this logic will not work in all case. We have to
If
formula.
the exchange ratio is based on a fair value, this logic will work. But if it is not based on a fair value, then this logic will fail.
Okay, sir.
So better not to use that. Okay, so let's come to the two alternatives now. In this case, now tell me, how many shares would AX given to BX shareholder? Sorry, how many shares BX would have given to the shareholders of AX? 550 shares.
Yes,
That's
sir.
what you calculated. Into what is the fair value of BX? 20. That is coming to 11,000. By the way, if you notice, this is equal to this 11,000 by chance or got to be on a logical level. At the end of the day, BX is supposed to pay AX equal to fair value, right? If the exchange ratio is based on the same parameters, then your purchase consideration has to be 11. Okay, now since the shares, the consideration is only in shares. The PC is in shares. I now want to understand, by issuing, let me ask the question carefully, by issuing this 550 shares, how many shares would BX have acquired in AX? By giving the shares to AX, how many shares would BX get a control over AX? बसंती, तुम्हारा नाम क्या है?
600.
600 shares.
600 shares.
Right. It is 600 shares and the price is 18.33. Is this also coming to 11,000? Has to be. So it is better that you show both the alternatives to the examiner. Tell him clearly that I know the funda, that this is the number of shares which would have been issued, and this is what I would have acquired. The more reliable measurement of the consideration is not what you give, but on the basis of what you would have acquired, the fair value of acquisition. So we acquired 600 shares in AX, and the share is worth 18.33. Great. My step number 4 is done. Now we can go to the next step. That is step number 5. Even in this case, the step number 5 is not applicable. There is no NCI. So in terms of step 5, NCI is not there. Then we go to the step number 6. And in terms of the step number 6, we need to calculate the goodwill or the capital reserve, what we call bargain purchase gain. Similar calculations will be done at this stage as well. So in this case, we will consider the purchase consideration, add the NCI if any, compare this with the net assets on acquisition date. So purchase consideration was 11,000. There was no NCI. And what was my net assets?
10,100.
Yes, it was 10,100. So we get a difference goodwill that is to the tune of 900. Okay, now we need to make the balance sheet. And can you tell me which company is going to make a balance sheet? BX, AX, or ABX?
A and B both.
Legal acquirer, beta. So legal acquirer will be which company? ABX.
ABX.
So consolidated balance sheet is going to be prepared from the point of view of ABX, number from the ABX perspective, and the value from the accounting acquirer perspective. So I guess we can just look at the figures in the balance sheet. I'm keeping the question in front of me. So first tell me, for AX and for BX, when you're going to make the balance sheet, whose fair value will be taken, AX or BX? Acquiree is AX. So we'll take the fair value of AX and we're going to consider the book value of BX. So let me start with the asset side of the balance sheet, non-current assets. We've got a property, plant, equipment. I guess AX had a fair value 9,500 and BX is supposed to be 7,500. So I think this is coming to 17,000. The next is goodwill, least I forget. The goodwill is to the extent of 900. And then we are given investments. Investments, no fair values are given. So investment is 1050 and 550. I guess that comes to 1100. No, sorry, not 1100, 1600. So this comes out to 1600 is the investments. Then non-current assets are done. Then we've got current assets. Current assets, we are given the inventory. What was the fair value of the inventory?
1,300, sir.
1,300 for AX, and BX will take the book value, and that is 2750. That is 4050. And then we've got the trade receivables, 1,800 plus 4,000. That makes it 5,800. And then there is a cash and a cash equivalents, 450 and 400. 450 plus 400, that makes it 850. So this is the asset side of the balance sheet. 17,900, 1,600.
30,200.
Okay, great. This is 30,200 is the total of the balance sheet. Super. Now we can go on to the liability side of the balance sheet as well. So let's see on the liability side, equity and liability. So on the equity and liability, we're going to first consider the equity. And in the equity, we're going to consider the equity share capital. Can you tell me the number which we are going to consider out here? Whose perspective? AX, BX, ABX.
BX.
ABX, sir.
Acquirer ABX.
ABX.
2,500 shares is what was issued, I think, by ABX, correct?
Yes.
1,400, 1,100 shares. And as far as the consideration is concerned, it is appearing at 11,000. And then we are given the other equity, and other equity of which company? Outer column, accounting acquirer. And that's BX. That's to the extent of 2,700. And then we can consider the non-current liabilities as well. And in terms of the non-current liabilities, we are given the 12% debenture. He's already said something about the 12% debentures. New debentures will be given against the old series. So we're assuming that new debentures are given. And that is to the extent of 3 plus 4. That makes it 7,000. And then there is a current liability, which is trades payable. And this is again book value, 1,000 plus 1,500. That makes it, I guess, 2,500. So hopefully this should tally my balance sheet as well. Let's see if the balance sheet is agreed. Did we miss out on any information?
Sir, reserves.
I took the reserves, right? It was... Oh, I didn't take the sum total of the equity of both the companies. Sorry, missed that out. This is, we need to add the, sorry, just a second. As far as my reserves are concerned, so this is appearing to the extent of 2,500 shares, and this is correct. I guess my other equity needs to be rectified. So my other equity is appearing to the extent of, no, that was correct. Other equity of the accounting acquirer was how much in the balance sheet?
Sir, 2,700.
2,700. I think that should remain. 2,700 other equity should remain. So where did I miss out? Oh, my purchase consideration was not 11. Was it 11? It was 11, or the purchase consideration was different?
सर दैट्स व्हाट आई वाज सेइंग सर हमने जो नए इशू किए थे 550 को हमने कंसीडर करना था और उसके 1000
Yes, we had issued a total of 550 shares. That is correct. So 550 shares are issued. Let me just check up the answer in the study mat as well. So this is appearing at, this is the A part. This is appearing at 12,50,000 shares, 7 lakh to BX and 550 to AX. Okay. We had a total of 700 shares of BX and 550 shares. Oh yes. How many shares were there for BX?
700 shares was with BX and we additionally issued 550.
550. Correct. My error on that. Yes, and the shares were worth 10 each. Okay, I got the point. So we just need to rectify this part, this number, and this needs to be rectified. Okay, so we can say number of shares of BX was how much? 700, right?
Yes, sir.
And the number of shares which is issued is 550. That makes it a total of 1250 shares
Yes.
with a issue price 20. So 10 is the face value. That
Yes.
works out at 12,500. Then
And
rest would be a
yeah.
premium. So existing was 2,700.
Yes, sir.
And there is going to be a premium at the rate of 10 rupees per share. My error.
So premium will be at 550 into 10.
Yes, sorry, not all the shares.
Yes.
550 shares into 10. You're right. So this will be 2,700 plus 5,500. I think 8,200. Now let's
Yes.
see, is the balance sheet tallied? Yes, it is coming to 30,200 is the total of the balance sheet. Correct. Right. So this makes the consolidated balance sheet as well. Reverse acquisition is completed. I've done both the cases with you. The illustration is based on a new company. That TYU2 is based on a new company is not created. Now, there is something which was pending as far as that question professional and dynamic is concerned. So I just want to take you a little back now. Reverse acquisition is done on the consolidated balance sheet as far as acquisition accounting is concerned, because I said I'm going to give you a connect in terms of Ind AS 27 and Ind AS 103 and Ind AS 110. So before I give you a break, because I want to start common control fresh after the break. So let me first, I think, give you the insight on the connection between the three standards. Now watch this carefully. I'm just trying to now give you the connect in terms of 103 and 27 and 110. I'm back on acquisition accounting. Now watch this carefully. Let's consider company A acquires a control over B, and A is the accounting and the legal acquirer both, acquisition accounting. So let's see that this is the books of A. Let's say this is the books of A. And we are looking at the journal entry under Ind AS 103. This is also going to be in the books of A. And I'm now looking at a consolidated financial statements, which is as per Ind AS 110. Now, please vouch me carefully, though you will get a clearer understanding of the picture once I am done with 110. But just to give you a basic bridge now. Can I say when A acquired shares in B, he would have done the entry investment account debit. And if the consideration is paid, let's say in cash, assuming the consideration is paid in cash, so he puts the entry investment account debit, that is investment in B, and the bank gets a credit. Can I say this entry is recorded at the cost? And basically, when you're recording this investment, you are complying with Ind AS 27, recording the investment at cost. It's just like normal entry, what you used to do in intermediate stage. As per accounting standard 13, that's what we're doing as per Ind AS 27. You made an investment, so investment gets a debit and the purchase consideration bank gets a credit. If it is paid in the form of equity shares, you take a credit to the equity share capital and the premium, whatever. So this could be bank or this could be equity share capital plus security premium, whatever the case might be. Now watch this carefully. In terms of Ind AS 103, what you did, you put the entry net assets of the subsidiary is taken at a fair value. And you are going to give a credit to the purchase consideration and a credit to the NCI. And you're going to get a balancing figure in this entry, which is supposed to be goodwill. This is what you do in terms of Ind AS 103. Now, my advice is that instead of recording this purchase consideration, why not give a credit to the investment, which is already created in the books of accounts? Now, what's this consolidation? You did the entry investment debit, and now you've given an entry investment credit. Now merge the two entries under Index 27 and under Index 109. And if you see, if you know some basics on consolidation, if you just know some basics on consolidation, when you are going to make a consolidated balance sheet, which I will prove it to you under Index 110 also, but if you know the basics, you can see what is being done. This investment which is there in the balance sheet of the company disappears. I gave a credit to the investment, so this investment disappears. And what takes in its place? You record the goodwill, you record the net assets, and this is 100% of the net assets, and you record the NCI. You're going to see this later under Index 110. When we come to the practical insights of consolidation, you will see in a consolidated balance sheet, investment is replaced by 100% net assets with a goodwill and the NCI. So this entry is basically helping you to make a consolidated balance sheet as on the date of acquisition, which means Index 103 acts as a bridge in terms of Index 27, separate financials of the holding and the consolidated financials of the parent company. In the separate financials, you've got investments appearing at a cost. And in the consolidated financials, the same investment gets replaced. And what takes in its place is the net assets, the goodwill, and the NCI. There are three components. This part, I will prove it once again when I come to the consolidation standards, and I'll remind you this particular aspect. But I thought it's important to give you this inputs at this stage. So in the question of that Professional and Dynamic Limited, where I did not make a consolidated balance sheet, but if you make a consolidated balance sheet, you've got the balance sheet of the parent company, which is nothing but the separate financial statements of Professional. And to the separate financial statements of Professional, if you incorporate the Index 103 acquisition entry, the resultant balance sheet is nothing but it is a consolidated balance sheet of Professional. I hope, friends, I made sense on that. Did you get my point?
Yes, sir.
Great. So I did not make the balance sheet, but I thought I'll give you the connect between the two. Okay, now I think it's a little time to give you a break as well. We're done with the second part of the standard, that is reverse acquisition, which was quite a complicated one. Now we've got some easy part of the standard, that is common control transactions. So we'll first take a break and then we'll do the concept of a common control, which is Appendix C of the standard. Enjoy your break, friends. I'm going to join you in 10 to 12 minutes time. Enjoy your break. Welcome back, friends. So I hope you had a relaxation of mind. I think the technical part of the standard gets over now, and we are on the last leg of the standard, which is pretty easy indeed, and that's the common control transactions. We had a basic flavor of what is a common control transactions, where I gave you the inputs that it is something which is a related party transaction. Now, there are two aspects what we need to discuss in terms of common control. One is how do you identify that it is a case of a common control transaction? And the second is once it is a common control transaction, then what kind of accounting is prescribed under the standard? So I think let's begin with the agenda number one. What is the factors with which we will decide it's a common control? So let's do one thing. Let's take first a basic example, then we'll go on to some more details as well. So I'm going to first of all take you to the illustration which is given in the study mat, where we're going to see how do we identify the concept of a common control. So let's have a look at the concept of the common control with illustration number 30. So I think I'll read this illustration also, but I think first I'll give you a simple example on what is the concept of a common control to begin with. Okay, I think before we read this particular illustration, let's make a little walkthrough with a very simple example what could be a common control. Let's consider a simple case of a demerger. Let's consider the simple case of a demerger. So let's first understand with an example what is a demerger, and then we'll consider that what is the role of common control transaction in this particular case.
Excuse me,
Imagine, yeah.
sir, in the reverse acquisition related query, it is we have solved two questions. First one is related to A and B limited, and the second one is AX and BX.
Yeah.
In first, when you have explained the consolidated balance sheet, you have told us the 3 points. First one is the legal. We will prepare it as per the legal acquirer's point of view.
Correct.
And second one is number of shares would be as per the perspective of legal acquirer.
Correct.
And values we will consider as accounting acquirer, है ना?
Correct.
तो जो हमने सेकंड एग्जांपल किया, तो वहां पर बी इज लीगल, बी इज
BX.
the legal acquiry, BX.
BX is better, not the legal acquiry, it's the accounting acquirer.
Yes, accounting acquirer, then legal acquiry हुआ ना वो?
हाँ, legal acquiry or accounting acquirer, correct.
Yes, sir. And we have considered the purchase consideration part. I got confused in that, sir.
Okay, I'll tell you. The purchase consideration you're talking, or the number of shares?
Equity share capital in consolidated balance sheet, sir.
Okay. Let me just come back to it. There is a slightly difference between the previous example and the current one.
Sir.
I'll just tell you the details. Okay, let me just come back on the agenda out here. Now, in this particular case, if we look at the number, now, let's first go back to the original question, the TYU2 which we did, in which there was existing company A and B. So when you had the existing company A and B, we said he is the legal acquirer.
Yes, sir.
He is the legal acquirer. So which means that in his balance sheet, the number of share was 100. And he issued a total of 150 share, that makes it 250. I think that would be clear, right?
Yes, sir.
Okay, now in this case, we are looking at AX, we are looking at BX, and we are looking at ABX as well.
Yes, sir.
Now, in this particular case, there was no new company. Since there was no new company, we could easily pick up the shares of the existing company.
Yes, sir.
And add the further shares as well. Now, in this problem is that in this case, there is a new company which is getting created.
Yes,
so when
sir.
a new company is getting created, what I'll have to consider, I'll have to consider the number of shares which is given by BX only. I will not be able to consider the number of shares which is already in existence, because in this case, the problem is if I take the shares of BX plus what is given to AX, you're considering shares of both the company, right?
Yes, sir.
Now, since there is a new company, ABX, which is come into the play, in this particular case, I can't consider just ABX. So
Yes.
because of the difference that no new company is created and a new company is created, this difference will arise. So you can say when you have got a case when no new company is created, you would simply add up the shares of the legal acquirer and what the legal acquirer actually gave.
Yes, sir.
But when a new company is created, I would consider this is 700, and in this particular case, we add that 550, we get the total of 1250 shares.
1250 shares. Yes, sir.
Correct?
Yes, sir.
So basically the difference is only because of the fact that new company is not created and a new company is created. Though if you look at the language which is given in the Appendix B, the Appendix B very clearly states that the number of shares in the balance sheet is going to be based on what is the position of the legal acquirer. But you know, the standard has not given us a deeper guidance in terms of two situations, that if a new company is created or if it is not created, how do we tackle the case? So I can say there are now two different variations in terms of calculating shares. When new company is not created, you consider the case what we did in TY2.
Yes, sir.
And if a new company is created, the number of shares will be taken on the basis of what the BX company already has and the other company. Because in this case, we are making a balance sheet based on a new company, but then both of them are existing company. So I need to consider the total number of shares which are there. That's the difference.
Sir, it means the 550 shares we consider related to AX Limited. Is it?
Yes, 550 is on the basis of what you are giving to the shareholders of AX.
Yes, sir.
So 700 takes care of BX, 550 takes care of AX. So combined put together, it considers the shares of both the companies.
Yes, sir. I got confused related to the 2500 shares and the 1250 shares. That's why.
Okay, okay. Because in this particular case, when we are considering 1250 shares, this
Yes.
is, you can say BX, and this is what is given to shareholders of
Yes.
AX in BX.
Yes, sir.
So maintaining the, you can say the parity in terms of both the factors, 700 is also BX and 550 is also BX, but given to AX.
Yes, sir. यानी कंपनीज तो वही है AX और BX से रिलेटेड, बट हम BX के अंदर भी जो AX का शेयर BX ने
Yes.
लिया उसको कंबाइन करके ABX में शो कर रहे हैं.
Correct, correct. So we are basically, and if you notice what we have done, we have indirectly incorporated the purchase consideration only, because we have taken 550 into 10 and we have taken 550 into 10. So in the balance sheet, the purchase consideration has got inserted to the extent of 11,000 as a part of the share capital face value and as a part of the security premium in other equity.
Yes, sir. Clear, sir.
Great, beta.
Thank you, sir.
You're welcome, beta. Okay, so
Sir,
let me.
I had a question too.
हाँ जी बेटा.
Sir, while we were making the consolidated balance sheet, we took the other equity of BX, but we didn't take the other equity of AX because we have to take the fair value of AX.
Yes.
Is that
No.
right?
In any case, you see, when you make a consolidated balance sheet, you incorporate the assets and liabilities of the accounting equity, not the other equity.
Okay,
Whether
sir.
it is acquisition accounting or it is a reverse acquisition, the assets and liability. You see, what is the acquisition entry of 103? If I look at acquisition accounting, you incorporate the assets and liability. Do you incorporate the other equity of the equity?
No.
Correct. So even in terms of reverse acquisition, in this case also, you are incorporating assets and liabilities of the accounting equity, not the other equity. So other equity would appear only to the extent of the accounting acquirer, because all the figures in the outer column are from the point of view of the accounting acquirer. Assets, liability, both the company. Accounting, acquirer, equity. But other equity is always only for the accounting acquirer, whether it is an acquisition accounting or it's a reverse acquisition.
Thank you, sir.
You're welcome, beta.
Clear.
Okay, so let's now come to the case of common control. So as I said, there are two agendas of discussion now. One is to give you insight, how do you identify that it's a common control transaction? And the second is, how do you do the accounting for the same? So I'm going to take first of all my own example, then I'll come back to the illustration. Let's see a case of a demerger. Now the question rises, what exactly is a demerger? So let me first give you an exposure in terms of what a demerger is. So let's look at an example. Let's say there is a company AB Limited, and this company has got two divisions, division A as well as a division B. So there is a company AB Limited which has got two divisions, A and division B. Now there is a particular shareholder, let's say Mr. X, who has got, let's say, 75% shares of this company AB. Now what happens in this particular case, Mr. X is in control of this company, because if he's got 75% stake in this company, then he's got a control of this company. So with the 75%, we can definitely say that he's got a control over this company. Now, what comes at the back of the mind of this company is, let's say out of these two divisions, one is a profitable division, another is a loss-making division. So what the company wants to do, they basically want to carve out a particular business out of this company, because I consider that A is a profitable division and B is a loss-making division. So unnecessarily, the loss of division B is disturbing my financials. Because with profitable and a loss-making division, it is disturbing the overall profitability of the concern. So what he decides that let me create a new company B Limited and let me transfer the division B from this company to another company. Now the problem out here is, if you transfer this division B to another company and AB creates B as a subsidiary, mind the words, if AB creates B as a subsidiary, the problem will still remain. Because if B is a subsidiary, then it will be consolidated in AB Limited, and the loss-making division B is still going to be reflected as a part of the consolidation results. Because when AB was making separate financial statements, in that particular case, the division A and B was resulting in a, let's say, overall loss of the company. Now, if he segregates the division and structures the company that B becomes a subsidiary, the position doesn't get solved, because A's standalone financials will become profitable, but when he makes a consolidated financials, because B is a subsidiary, then he will spoil the consolidated financials. So AB decides to do the structuring in like this way. He says, let me create a separate company B Limited, but the shares of this company is given to the shareholders of the company AB and not to AB. So what is done, that AB carves out the business of the division B, but doesn't keep the shares of B with his own company. So he says, I will not keep a control over this company. Let the shares be given to the shareholders of the company itself. So what happens, that this company is created and the entire shares of B is given to the shareholders of AB. So Mr. X also gets a 75% control over company B. Let's say the number of shares are given in a same exchange ratio, so that all the shareholders gets the same percentage stake in company B as well. So what happens now in this particular case, this company also comes under the control of Mr. X. Now, if you notice, the transaction is like this, that both companies AB and the company B are under the common control of Mr. X. Before the business combination, the company AB was under the control of Mr. X. After the business combination, also the company AB and B are still under the control of Mr. X, which means that pre and post business combinations, the company are under the common control of that individual Mr. X. This is a case of a demerger, and this also means that this transaction between the two companies is between a related party. Because in this case, Mr. X is the common thread who is under the control, who's having a control of both the company. So when you say a common control transaction, you need to prove that before the business combination and after the business combination, the same individual or the same group of shareholder, mind the words. We need to prove that before the business combination and after the business combination, the same individual shareholder or the group of shareholders must get a control over the company. In such a case, we will say it's a common control transaction. Now the question rises, why did the standard setters agree that we should distinguish this kind of a transaction from an acquisition accounting or from a reverse acquisition accounting? The reason is that if you are acquiring a company which is unrelated in nature, there will be a fair value concept. So they prescribed a fair value accounting in terms of acquisition accounting and in terms of reverse acquisition. But when it is a transaction with related parties, in those particular cases, they allowed the concept of book value accounting. If you remember, in terms of accounting standard 14, merger, that is called the pooling of interest method, was allowed for both unrelated and related party transaction. But the standard setters decided that a concept of a pooling of interest can only apply if it is supposed to be a related party transaction. So they decided that if there is a transaction which is happening between related party transactions, if you can prove that the control pre and the control post business combination lies with the same shareholder or lies with the same group of shareholders, then I will give them the advantage of doing a book value accounting. And they called it as a pooling of interest method. So this was, you can say, a kind of a situation where you've given exceptions only to related party. You said, okay, if there is a transaction between related parties, we are going to offer you a book value accounting. Because earlier, as per the ICAI in terms of AS 14, the book value accounting was open to both related and unrelated party. Now, I will not get into the nitty-gritties of explaining you that why companies would prefer a book value accounting. Because if you look at the ICAI era in terms of AS 14, trust me, many companies were trying to manipulate and create a merger accounting. They used to meet those 5 conditions. There were 5 conditions in AS 14, and all those 5 conditions, companies used to structure the deal in such a way, do certain transactions before the merger, and ensure that some way or the other, the things used to take the shape of a merger accounting. Now, the standard setters also understood that most of the acquisitions under ICAI which were happening were basically based on a merger concept, were basically based on a book value or a pooling of interest concept. So they wanted to, loop out this fact that companies may not artificially structure the deal in such a way that the common control becomes visible. So which means that if there is a control of Mr. X on AB, this is not something which was created artificially. I may not make much sense at this stage without an example, but they decided that in order to fall under the purview of common control, they basically decided 2 parameters, which I'll explain with an example. Number 1, you should be able to prove that pre and post business combination, Mr. X is in the control of both the companies. And number 2, I also need to prove that this control was not artificially structured. We should be able to evaluate that, the control is something which the standard says is not transitory in nature. Now, what is that transitory in nature? What kind of manipulations company can do? I'll explain that with an example. But as of now, what you need to keep in mind is that if you want to bring a particular transaction in a common control, you need to prove 2 parameters. Number 1, you need to prove that there is a control pre and post business combination. And number 2, you need to prove that this is not something which is artificially structured. So what I'll do now 2 illustrations with you. One where I will just work on the question number 1. That how do you make an assessment that there is a control pre and post business combination? And then second, I'm going to make a walkthrough in terms of how do I prove that there is no intentional manipulation. The control is not something which is artificially created. Once we're done with these illustrations, you'll get a better idea of the movements. Then I'll document the steps also to you, the 2 steps which I said. So don't worry, as I'm discussing, you must be getting some kind of a flavor. Okay. But after the illustrations are done, you'll definitely get the map plan. Let's now see illustration 30. Now, in terms of illustration 30, it says company X, the ultimate, or I think let me first take another question with you. I think it's better to take illustration 31 first. Yes, I think let's go to illustration 31 first. So let's first have a look at illustration number 31. Now, let me just read the inputs in illustration 31. It says in this particular case, ABC and XYZ are owned by 4 shareholders, B, C, D, and E. So there is a company ABC Limited and XYZ. So this company ABC Limited and the company XYZ Limited, they're owned by 4 shareholders, each of which has got a 25% shares in each company. So B, C, D, E, everybody has got 25% shares in both the company. Now let me put it like this. I don't know that in this particular case, who has got a joint control over these company. Now, there are a few things which I will explain and I'll document later. But one thing, as of now, I do not know that who has got a joint control over these company. Why did I use the word joint control? In this case, there is not a single shareholder, but there are a total of 4 shareholders who've got a combined, you can say 100% stake. But for a control, you just need more than 50% stake. Now, in this particular case, if you consider, let's say A plus B, or let's say you consider any other combination, A plus C or A plus D, whatever. If you consider this combination, it works out at 50%. So if you combine only 2 shares, if you combine only 2 shareholders, nobody can get a control of this company, whether it is AB or whether it is AC, AD, whatever combination. But the moment you enter into a combination of 3, let's say A plus B plus C, it makes it 75%. And the control will come. But this is not a case of control. It is a case of a joint control. It is a case of a joint control. Now hear me very carefully. I'm going to create a 3-step model now, based on the assessment, based on the identification of a common control. The situation number 1, you need to see that is there an individual who controls the company, or is there a group of individuals who control the company? So you need to see that is there an individual or is there a group of individuals who control the company? Now, if there is an individual who controls the company, I can directly go to step 3. But if there is a group of individuals who control the company, I need to go to step number 2. We'll see the step 2. So what is the first thing you need to see? That is there a control by an individual or group of individual? If it is a control by individual, you go to step 3. If there is a control by a group of individuals, you need to go to step 2. So coming back to the question, in this case, it is owned by 4 shareholders. So we can say that at least 3 people get a joint control. In other words, you can even say in step number 1, is there a control of 1 or is there a joint control of more than 1? If there is a control by 1, I go to step 3. If there is a joint control more than 1, I go to step number 2. Now, what is step 2? We'll see. It says shareholders B, C, D have entered into a shareholders agreement in terms of governance of ABC, due to which they exercise a joint control. The 3 shareholders B, C, D, not E, have entered into a contractual agreement to act jointly, to exercise the joint control. This is step number 2. If you want to prove that it's a common control, what is important is the presence of a contractual agreement between the group of shareholders. If the contractual agreement is not present, it cannot be a common control transaction. Let's put it like this. In step number 1, you will first of all evaluate, is there a control by one? Step 3. If there is a joint control by more than one? Step 2. In terms of the step number 2, you need to evaluate that is there a contractual agreement between the group or not? If yes, you go to step 3. If no, it is not a common control transaction. I hope, friends, you got the point. Let's see further. So very clearly it says in terms of the agreement, they exercise a joint control. Determine whether the two companies are under the common control of BCD. Now you can see in the diagram very carefully. They've segregated BCD only, E has been kept separately. They've segregated ABCD and E has been kept separately. So in this particular case, I would say yes, there is a common control unless you prove it that there is any manipulations, but I'm not given any details in the question to verify my step 3. Now let's have a read. I'm just going to take you on the direct answer based on this. So let's have a look in terms of this. So I am given the status. It says, in the instant case, both ABC and XYZ jointly controlled by group of individuals BCD as a result of contractual arrangement. Therefore, ABC and XYZ are under a common control. So let me just, I think, put my inputs once again. If I were to apply my 3-step model, I would say step number 1 is there a control or is there a joint control? When I say control, it is by one. When I say it is joint control, it is more than one. So the first thing you need to see that is there a control by one or is there a joint control more than one? If you say there is a control, you go to step 3. If there is a joint control, you go to step number 2. So watch out the steps carefully. So once you say that yes, there is a joint control, then in that particular case, you need to see, is there a contractual agreement which is entered between those group of individuals? The presence of the contractual agreement is a prerequisite. So if you say yes, they've entered into a contractual agreement, I go to step 3. And if you say no, it cannot be a common control transaction. Even though there is a joint control, but since the contractual agreement is missing, you cannot bring it under the purview of common control. And then you come to step number 3, which is like what we call an anti-abuse clause. Which is called an anti-abuse clause. I want to ensure that the companies are not structuring the deal intentionally to bring it under a common control, where the standard uses the word that the control is not transitory. This anti-abuse clause is to prove that the control is not transitory in nature. Now, how do you evaluate this step number 3? That I'll explain with an example further. But before that, let's see illustration number 32 as well. Same example, which is illustration 31 with a variation now. It says ABC, XYZ are owned by 4 shareholders with 25% shares each, same one. There is no agreement between any of the shareholders that they will exercise the power jointly. It cannot be a common control because it fails my step number 2. Because if there is a agreement, then there is a joint control. If there is no agreement, there is no common control. I'm just reading the inputs. Since there is no contractual arrangement between the shareholders who will exercise the collective control, ABC, XYZ are not considered under the common control, even if there is established pattern of voting together. It doesn't make a difference that they've been acting together. Historical evidence of acting together cannot prove the point. I need an agreement which proves that they act together. I hope, friends, I'm very clear on my step 1 and in terms of step 2. Correct?
Yes,
Are
sir.
we clear so far? Great. So my first step, I'll document the steps, no worry. So the first step is to evaluate that is the company Under the control of one, go to step 3. Under the joint control of more than one, go to step 2. C, is there a contractual agreement between the group of shareholders? No, cannot be common control. Yes, then I go to step 3. Now, what is this step 3? What is this anti-abuse, or what we call the not transitory fact? Let's, I think, consider this. I will now consider this. This is one of the interesting example, illustration 33, which explains my step number 3. It says ABC had a subsidiary X Limited, which is acquired on 1st April XX0. ABC acquires all the shares of Y on 1st April 17, 2X17. So ABC has got now 2 subsidiaries. What's this clear? ABC has got a subsidiary that is X, and he acquired all the shares of Y on 2X17. ABC then transfers the shares in Y to X on 2nd April X17. See the interesting part. On 1st April, he gets shares in Y, and on 2nd April, he passes on the shares to the subsidiary, that is X. He transfers the shares in Y to X. How should the above transfer of Y into X be accounted in the consolidated financials of X? Now watch this carefully. What is the manipulation which is happening? Now, in this particular case, let's visualize what is happening in this particular case. Watch this very carefully. This is my inputs on the step number 3. He says before the business combination, ABC had a control over company X. And then what happened on 1st April, ABC got a control over both the companies X and Y. Now, if somebody asks me that before the business combination of X and Y, somebody puts me a question, before the business combination of X and Y, was the 2 companies under the common control, was under the control of ABC? Yes. I would say before this deal happened, is company X and company Y under the control of ABC? Yes, it was under the control of ABC. Now see. Now what happened after the business combination? The company X took over the company Y. Now we are putting a question to ourselves. The deal is between X and Y. The deal is between X and Y. Is the company X under the control of ABC before business combination? Is the company Y under the control of ABC before the business combination? Please hear the words carefully. Is the company X under the control of ABC? Is the company Y under the control of ABC before the business combination? Yes. Is it still under the control of ABC after the business combination? Yes. The company X and Y was under the control of ABC pre-combination and post-combination. But do you think that technically speaking, company Y was under the control of ABC? Not really. Now watch this. If company ABC had not acquired a control over Y, on 1st April, if he would not have acquired a control over Y, in that particular case, company ABC would have got a control over X, and X would have directly got a control over Y. X would have directly got a control over Y. Now let me put a question. Does ABC have a control over X pre-combination? Yes. Does company ABC have a control over company Y pre-combination? No. So company ABC got a control over company Y just 1 day before. He got a control over company Y just 1 day before. There was no control which company ABC got on company Y. Which means the companies artificially created a control for 1 day. Ek din ka prime minister. Do you get my point? So in this particular case, this deal was artificially structured so that company Y comes under the common control umbrella of company ABC. This is called the control is transitory. You created a control over a short period of time. Let me read now. It says, as I said, we need to prove that the control should not be transitory. The term transitory has been included as a part of the appendix. The word transitory has been included in the common control to ensure that acquisition accounting applies to those transactions that look as though they are combinations involving entities under common control, but they represent genuine substantive business combinations with unrelated party. Now, I will not get into the details of explaining you why the companies would prefer a common control, why the companies would prefer a merger, a book value accounting. I think then I'll spend another 1 hour explaining the advantages of merger accounting. But the company, the standard setters were very clear on the agenda that companies do prefer a book value accounting, and you'll see some advantages of book value accounting coming in. So they were very clear on the picture that we don't want the companies to artificially structure the deals in such a way that they bring under the common control. So in this particular case, you created the control 1 day before the deal between X and Y happened. So this is supposed to be manipulative in nature. The control which ABC had on Y should be for a couple of time. Now, what is the time period within which the control should be there is not defined, because the standard does not give you that what is the concept of this. In fact, let me tell you that to this particular concept of common control, there is a lot of research still going on at the International Accounting Standard Board level as well. You might see in the couple of years, maybe a year or two, there might be a separate standard which might be released under the concept of common control transactions. Because still the International Accounting Standard Board is evaluating that what kind of manipulations the companies are doing, where they are trying to bring these companies under the ambit of common control to get advantage of a book value accounting. Now, let me do one thing. Let me pen this down. So we've taken the first agenda. So let me just put down the first agenda to you. So I am looking at now the common control transactions. I'm looking at the common control transactions. So in terms of the common control transactions, the guidance, as I said, is given in the Appendix C of Index 103. And let me also tell you that if you look at the corresponding IFRS, this common control is not supposed to be an appendix. This is one of the effects which is given in terms of IFRS 3. So the first agenda is how to identify. The first agenda is how to identify that the transaction, how to identify that the transaction is CC, common control. So the first agenda is to decide how do we identify that the transaction is supposed to be a common control. So for which we're going to consider a 3-step model. So for this, we're going to consider a 3-step model to evaluate whether it's a common control. Step number 1. Is there a control? Is there a control or joint control? Is there a control or is there a joint control? Control means by one. And when I say joint control, it is supposed to be by more than one. So if there is an individual or there is a company, single individual with a control, or is it multiple companies or multiple shareholders with a joint control? So you need to see that is it a case of a control or a joint control. So if you say it is a case of a control, you're going to go to step number 3. If there is a control by one, you go to step 3. But if it is a case of a joint control, you need to go to step number 2. So the first fact is to see that is there a control or is there a joint control. Now, when you say that there is a joint control, we go to the step number 2. So we go to the step number 2 in this particular case. And we say that if there is a joint control, we see, is there a contractual agreement? We need to see that is there a contractual arrangement or agreement? The focus is then on the contractual agreement. Is there a contractual agreement between the shareholders? So is there a contractual agreement between the shareholders? In the brackets, I'll put it, who have joint control? Who have a joint control, putting it as JC. So what is important is the presence of a contractual agreement if there is a joint control. So we say a yes or a no. So if you say yes, there is a contractual agreement, you go to step number 3. And if you say no, there is no contractual agreement, then in this particular case, it cannot be CC. It cannot be a common control transaction. Then in that particular case, acquisition accounting or reverse acquisition accounting would apply. So in this particular case, if this happens, we will apply acquisition accounting, or we will apply reverse acquisition accounting, as the case might be. Then it becomes a transaction which is as good as unrelated parties. And then comes the step number 3, wherein we need to prove that the control is not transitory. The control is not transitory in nature. The control is not transitory. Now, when we say it is not transitory, it means it is not artificially created. It is not artificially created. It is not artificially created before business combination. So we need to see, as we saw in the illustration, that it is not artificially created before the business combination. And I think we'll just make a mention as well that this is an anti-abuse clause. This is an anti-abuse clause. So this is an anti-abuse clause to avoid accounting at book values for companies. This is to avoid accounting at book values for companies which are related parties. So they are related parties, but this is artificially created for a couple of days or maybe a couple of months before. So the standard says that the control which you see pre and post business combination should not be something which has been temporarily created. You need to ensure that this control was there for a pretty long time. Now, what is that period of time, of course, is not defined in the standard. Right, friends, so that was the agenda number 1. That is in terms of how do you identify that it is a common control transaction. See the presence of control or joint control. And if there is a joint control, see there is a contractual agreement, and prove it to me that the control prior to the business combination was not artificially structured. It was there for quite some time. Then only I will generally consider that it is a related party and give them a benefit of a book value accounting. Now comes the second agenda. Now the second agenda is in terms of how would you do the accounting in terms of common control transactions. Trust me, the accounting is very simple. It's going to be very, very simple as far as the accounting is concerned. I would now put it like this. Let's take the case of a demerger only. Let's consider the same example of a demerger. So let's take the same example. There was a company AB and there was a company B Limited. This company had a division A plus B. We transferred this division B to the company B Limited, and let's see that if in a demerger, how would you do the accounting? So I'm taking the accounting considering the demerger as a base. Now see, watch this carefully. It's very simple. I need to do the accounting in the books of AB, closing the assets and liability, and I need to do the accounting in the books of B. So what we are going to do in this particular case, we are looking at the accounting in the books of B, and we're looking at the accounting in terms of AB. in the given example, let's see the accounting in the books of AB and let's see the accounting in the books of B. Simple. As far as B Limited is concerned, what he will do, he will record the assets of division B. He will record the liabilities of division B, and this will all be recorded at a book value, not at a fair value. The company B Limited, which is the demerged entity, the new company which is created, in this particular case, it'll incorporate the assets and liabilities of division B at a book value, nothing at a fair value. Book value accounting. You can't even record any new asset and liability if it is not in the balance sheet of AB. It cannot appear out here. So you're going to create this assets and liabilities, that is one. And as I mentioned, no asset or liability other than, no asset and liability other than in the balance sheet of AB. In the balance sheet of AB can be recorded. So we will not be able to record any other additional asset and liability if it is not there in the balance sheet of the company AB. It cannot appear in this entry as well. Only what is in the balance sheet of AB appears in the entry of B, and that also at a book value. The purchase consideration is going to be the quantum of cash given plus the face value, not the fair value. The face value of the shares issued. You're going to consider the face value of the shares issued. So the purchase consideration is the sum total of the cash and the face value of the shares issued. We're not going to consider the fair value of the shares. We're going to consider only the face value of the shares. And any difference in this entry, any difference which will appear in this entry is not going to be goodwill capital reserve, but it's going to be adjusted the way you'd use the pooling of interest method. It is going to be adjusted in other equity. So any balancing figure in this entry is going to be adjusted in terms of other equity. No goodwill, no capital reserve would arise. So the accounting in terms of this is absolutely similar to what is given in accounting standard 14, that is a merger, a pooling of interest method, where the company in this particular case will incorporate the assets and liabilities which are there in the balance sheet of the company AB. Book value, no fair value. Purchase consideration considering shares face value. No goodwill capital reserve. The difference is adjusted in other equity. Life becomes more simple. Now coming to the accounting in the books of AB, what is he required to do? He is required to close the liabilities. He is required to close the assets of division B, and this will all be closed at the book value itself. He will basically debit the liabilities, credit the assets, closing those assets and liabilities which are taken over by the company B. So this is basically closing. This is basically closing the assets and liability. And in this particular case, is he getting the consideration? No. The company B issues the cash to the shareholders of company AB. The company B issues the shares to the shareholders of AB. So what is the company AB getting? Nothing. So there will be no receipt in terms of this entry, and any difference in this entry will also be considered and transferred in the other equity. It is going to be adjusted directly in terms of other equity, that is so key. So this is basically closing the books of accounts, and that is incorporating things at a book value. So that is the reason we say that it is supposed to be a book value accounting. It's not a fair value accounting. Acquisition accounting is a fair value accounting. Reverse acquisition is a fair value accounting because they are transactions between unrelated parties. If it is a related party, only then a book value accounting is allowed. And even if there is a manipulation, I'll throw these related party people in terms of acquisition and a reverse acquisition accounting, because I need to prove that the control is not transitory in nature. Let's, I think, now see a question with you on this area. So we are now going to go to a question on this area. So there are a couple of illustrations given in the study material, as far as this area is concerned. So we'll pick up one of the questions which I love, because this is a question which was also there in the old course in CA final. I remember this question coming in CA final way back in the year, I think 2000, November 2000, this question came, and the same question has been done now under the common control in terms of the standard. Let's see illustration number 37. So let's have a look at illustration number 37. So let me read what is the inputs in 37. It says Maxi Mini has got two divisions, Maxi and Mini. So we are given the breakup of these divisions as well. Though we don't need the breakup in the balance sheet, but it's given so that we will be able to do the common control accounting and book values. So we're given the breakup of the assets and liability of the Maxi and the Mini division, and the total of the company is given. And thereafter, we are given something in the additional information. Then I am given in the additional information, it is decided to form a new company, Mini, to take over the assets and liabilities of Mini division. It's a demerger. It's a demerger, but it'll be demerger if the shares of Mini is given to the shareholders of Maxi Mini. Value the assets and liabilities of that division. Mini will allot 5 crores equity shares of 10 each in the company to the members of Maxi Mini. When it says the allotment is given to the members of Maxi Mini, this proves that it is supposed to be a case of demerger, because the Mini division is segregated and the shareholders of Mini is given to the shareholders of Maxi Mini. The members of Maxi Mini, therefore, to become the members of Mini as well without having to make any further investments. You are required to pass journal entries in the books of Maxi Mini, closing the assets and liability, and also the journal entries in the books of Mini, and show the balance sheets of the two company on the morning of 1st November. Well, there is nothing so special on the morning of 1st November. That is only telling you that I need a balance sheet post the business combination. The directors of the two company ask you to find out the net asset value of equity shares pre and post demerger. Net asset value means I need basically the intrinsic value of the shares pre and post merger, and then comment on the impact of demerger on the shareholders' wealth. So in this particular case, there are 3 focus points. Number 1, I need the entries in the books of the two company. Then I need to calculate what is the intrinsic value or the net asset value pre-post demerger and the impact on the shareholders' wealth. Okay, now I think I'm just going to make a walkthrough in terms of the entries in this particular case. Let's see the books of Maxi Mini in this case. So what am I supposed to do in the books of Maxi Mini? Debit the liabilities and credit the assets, and the difference is going to be other equity. Done. Let's have a look. You can see, first of all, if I go back on the balance sheet, we can see what is to be closed. You are required to close this Mini division's assets and liability. The property, plant, equipment has got a gross block of 300, accumulated depreciation 100. Then there is a current assets 300, and there is a current liabilities 100. So you can see the inputs, and there is a loan funds also. So let's see the entry. The current liabilities debited, closed. The loan is given a debit, close. The provision for depreciation debit, and the gross block given a credit. Basically a closure entry. Debiting all the liabilities appearing in the Mini divisions at the book value. The PPE given a credit at 300, and that's it. So what is the balancing figure in this entry? And of course, oh my God, that becomes dangerous, Whenever we do something technical indeed, this dangerous always happens with me. Just bear with me. Just get loaded in a couple of minutes. So in the meantime, as I said, the focus in terms of Maximini is simply the closure of assets and liabilities at book value, debit the liabilities and credit the assets, and balancing figure is going to be called as other equity, profit or loss which arises on a demerger. I hope the file gets saved for your uploading purposes. Well, hopefully yes or great. So let me just come back on the agenda. Yes, so here we were. So if you look at the entries now in this particular case, we can see that there is a balancing figure which is arising out here, which is the loss on reconstruction. This is nothing but the loss on reconstruction is what is going to get adjusted to other equity. So in the books of Maximini, we have basically debited the liabilities, credited the assets, get the balancing figure, loss on a demerger. Now let's see the entries in the books of Mini. Now as far as the entries in the books of Mini is concerned, we have incorporated the PPE and the current assets at a book value, the current liabilities and loans at a book value. That's it. So assets at book value debit, liabilities at book value credit, and the purchase consideration is given. 5 crore shares of 10 rupees is the PC face value. And the capital reserve becomes the balancing figure, which is nothing but it is other equity again. So one company is incorporating the assets and liabilities at a book value and the purchase consideration is recorded. Another company is simply closing the assets and liability without getting anything. Okay, now with this entries, I'm sure you will be able to draft the balance sheet as well, but I want to now take you to the second part of the question. So if I go to the second part of the question now, in terms of the intrinsic values, you'll now see something interesting to watch. If you look at the intrinsic value of the company, that means you take the net assets by number of shares, or you can take the sum total of the equity share capital plus other equity, that's as good as net assets. You divide the net assets by the number of shares. Now, if you look at the position pre-demerger, the company Maximini has got 700 crores of net assets by 5 crores. The intrinsic value is 140. If you look at the calculations post-demerger, so what you've basically done, you basically split the companies in two parts. So you get the pre-demerger value is 80 and the post-demerger is 60. That still makes it 140. Wow. Actually, if you notice in this particular case, the company Maximini has got 5 crore shares in the balance sheet. It issued 5 crore shares in Mini. The shares were issued 1:1. So every shareholder of Maximini is also getting 1 shares in Mini as well. Which means earlier the shareholder had 140 share, 1 share each. This was pre-demerger. Post-demerger, he is now got 80 shares, 80 rupees share, 1 share, and he's got 60 rupees, another 1 share. His wealth still remains at 140. Because earlier he had 1 share in the company worth 140. Now he's got 1 share in Maximini, 80, 1 share in Mini, 60, makes it 140, and the wealth remains the same. Is this by chance or is this got to be? It's got to be. So if the ratio of exchange was other than 1:1, it'll still be. You can match it on mathematical levels. Whether the exchange ratio is 1:1 or whether the exchange ratio is 2:1 or it is 0.5:1 would not make a difference. You can try it out. In a demerger, when you are going to give the shares to the shareholders of the company, ultimately the wealth will always remain intact. That was the third requirement of the question. The question was asking us to make the balance sheet post demerger, and he told us to calculate the intrinsic value because he wanted to test me in step 3 that what is the impact on the shareholder's wealth. Since this entire accounting is based on a book value approach, you can see that you're basically taking out a portion and putting it in another company. And everything which is being taken out is being put at a book value. So at the end of the day, If you're going to compare the intrinsic value pre and post demerger, the shareholders' wealth will never ever be impacted. So this is how the accounting of a common control transactions are done. So we've taken care of two aspects in this case. I have given you how do you identify it's a CC based on a three-step model. And we've also seen the accounting in the books of both the companies, which is transferring, and the company which is acquiring. Everything done at a book value approach. This takes care of my three kinds of accounting. We're now done with acquisition accounting, 7-step model, reverse acquisition, practically a 6-step model, and a common control, which is a 3-step identification, and then there is an accounting. Finally, our standard on Ind AS 103 is over, but the trail of the consolidation standards is not. Now, a journey in the next class will start on the consolidation standards with you. We've got a trail of standards coming in, Ind AS 110, then Ind AS 111, and then Ind AS 28, and a bit of Ind AS 27 as well. So I guess we are going to spend a good time. I guess the coming couple of classes is going to be spent on these particular standards with you, which would be almost till 23rd of January. That's all for the day, friends. Now my request, my advice would be that please do a consolidated revision of Ind AS 103. Do the questions in the study mat, practice questions from the past examination questions, RDBs as well, to get a good grip on the standard. There's one very interesting question which is given at the back of the study material and test on knowledge, which is one of the questions on RTP. It's a brilliant question indeed. Please try that question. It's a very comprehensive question based on the application of step number 3B typically. Right, friends, I think that seems to be time for the day, good for the day. Over to you for any questions on your side. Sir, I really enjoyed the whole lecture since it's part, especially reverse acquisition accounting. You make it very much interesting for us. Thank you, sir. Thank you, Ginny. That means a lot for me. Thank you very much. You always make my day, and I think it's always encouraging, to put in more and more dedicated efforts on that. Thank you very much indeed.
Thank you, sir.
Thank you, Beta. Thank you so much. Right, friends, on that note, I take leave from you. So see you in the next class. Bye-bye and take care. Angie, thank you. Thank you.